Hello, welcome to Group 4's group project number 5 of Wonky Widgets Manufacturing Company, presented by Josh Cantwell, doing the introduction in question number 3, John McCaw doing question number 1, and Bill Purdom doing question number 2. We were provided the following information. Wonky Widgets Manufacturing Company makes two widgets identified as C15 and C60. Selected budget data for 2021 was provided. We were provided information regarding the finished widgets, including the required material for each widget, direct labor hours, additional product information, direct material data. The management of Wonky Widgets expects a $25 per hour average wage rate in 2021. Wonky Widgets applies manufacturing overhead based on direct labor hours. Every year, the company's management determines the manufacturing overhead rate based on budgeted production levels for the year. Wonky Widgets maintains no work in process inventory, and management expects the unit cost for inventories of finished products to be in the same at the end of the year as at the beginning of the year. The following schedule details the composition of manufacturing overhead at the anticipated production levels. The following schedule details the composition of selling and administrative expenses at the anticipated sales levels. And we are informed that Wonky Widgets has an effective income tax rate of 40%. I'm going to pass it over to John to work problem number 1.
Thank you, Josh. So we will go ahead and take a look at problem number 1, which asks us to prepare an Excel workbook that contains the following schedules for 2021. And that would be a sales budget, production budget, direct materials budget, direct labor budget, a manufacturing overhead budget, and finally a budgeted income statement. So we'll go ahead and dive into those. We'll start with the sales budget. So we have the budgeted unit sales as given in the introduction for each widget, multiplied by their selling price per unit, gives us the total sales income that we'll receive from each widget. And then when you add the two of those together, that gives you our total sales with both widgets combined. So now we'll move on to our production budget. So once again, we start with our budgeted unit sales. We're going to add to that our target ending inventory. And when you add those together, that gives you the total units that you need. And then you subtract the beginning inventory to give you the required production in units. And of course, that's an identical process for widget C60 over here to arrive at C60's total production required in units. So with those two in mind, we'll go on and look at our direct materials budget. Once again, we're going to start with our required production in units. And we're going to figure out how much raw materials we need for each widget. So as given in the introduction, here we have it for both widgets. To find how much raw materials you need total, you would take the raw material and multiply it by the required production units to give you the total of each that you need. And then to simplify the math later on, I went ahead and totaled the two together. So for example, for raw material 1, I went ahead, as you can see in my formula bar, added the totals needed for C15 and C60 to give us the total of raw material 1 that we needed. I did the exact same thing with raw material 2 and raw material 3. And so we will go ahead and add our desired units of ending inventory as given in the introduction. to give us our total units of raw materials needed. And then just like before, we will go ahead and subtract our beginning raw materials inventory. And when we do that, that gives us our units of raw materials that need to be purchased. And so to figure out how much that's going to cost, we simply multiply the cost of raw materials per kilogram by the units of raw materials to be purchased to give us our total dollar amount for each raw material that we have to buy. And then when you add all of those together, that gives you a final cost of raw materials of $490,725. So we'll go ahead and take a look at our direct labor budget. Once again, we'll start with our required production in units and multiply that by the direct labor hours per unit to give us our total direct labor hours needed to manufacture each widget. Again, I'm going to combine those together for a company-wide total direct labor hours needed. We're going to multiply that by our $25 per hour direct labor cost to get our total direct labor cost of $1,273,750. Now we'll take a look at our manufacturing overhead budget. Our budgeted direct labor hours that we found in the direct labor budget right up here will be multiplied by our variable manufacturing overhead rate to give us our total manufacturing overhead cost. We'll add to that our fixed manufacturing overhead to give us a total manufacturing overhead cost of $580,830. And then we're going to subtract depreciation to give us the cash disbursements for manufacturing overhead of $509,500. Excuse me. So now we have to figure our predetermined overhead rate, which will simply be our total manufacturing overhead that we found up above, divided by our budgeted direct labor hours that we found in our direct labor budget to give us our predetermined overhead rate of $11.40. Now we'll take a look at the selling and administrative expense budget. Our budgeted unit sales, which for this one I went ahead and added the 12,000 unit sales of C15 to the 9,000 unit sales of C60 to give us a total of 21,000 budgeted unit sales. Our advertising expense, as we saw in the intro, is $50,000 plus 50 cents per unit. So you can see when we do that math up there, there's our total advertising expense. Sales salaries and commissions, as stated before, is $200,000 plus 5% of total sales dollars, which gives us our total sales salaries and commissions there. And then everything else is just outright given in the introduction. So when we total all of those together, we get a total selling and administrative expense of $828,500. And finally, we'll go ahead and take a look at our budgeted income statement. So you'll remember from our sales budget, we start with our sales income, subtract cost of goods sold, which you can see up here in my formula bar is simply the total manufacturing overhead cost added to the direct labor cost. That gives us our gross margin. From our gross margin, we have to subtract our selling and administrative expenses that we found just a minute ago to give us our net operating income. And then from that, we have to subtract taxes. As Josh stated in the introduction, taxes are 40% of net operating income, which gives us $474,810 in taxes. So we'll subtract that from our net operating income to give us a total net income of $712,215. And with that, we'll go ahead and go to Bill, who's going to take a look at problem number 2.
Thanks, John. This is Bill Purdom. I'm going to continue with question number 2. So part 2 states C15 is a long-standing product for which management believes that the price can be raised to $160 per unit with no effect on the demand. C60 is a fairly new product that management believes has significant potential. Management expects that reducing the price to $180 will likely double the demand. Would you recommend to management of Wonky Widgets that this strategy be executed? And explain our answer. So to do this, we first looked at, well, let's do exactly what they want, what management wants. So we increased the price of the C15 by $10 to $160, and then we decreased the price of the C60 from the $220 to $180. We also doubled the demand from 9,000 to 18,000, and then we continued to work through the problem with those assumptions. So the sales went up. You can see that. You can see that because of the increased sales and the production increase, that also impacted the production budget by those number of units. The direct material budgets were impacted because now we have to buy more materials to produce. You can see here that the total income or the total combined raw materials went up by 72,000 kilograms for raw material 1. Raw material 2 went up, and so did raw material 3. So that's what we're showing here. Then, of course, the total cost of the raw materials went up by about $238,500. Of course, because of the added production, so the direct labor hours also increased to complete the production, and our direct labor costs went up by almost $700,000 when you look at the math. Manufacturing overhead is going to also go up because of the direct relationship to the direct labor hours. So we had a delta of $172,800. The one thing that did see a benefit was the predetermined overhead rate would actually decrease by about $1.73 per direct labor hour based on the increased demands, and we had more direct labor hours to spread the cost across. So the selling and administration expense budget would also be impacted. It would go up by about $73,500 over our original expenses. So the bottom line, the budgeted income statement, you'll see that we had a sales of about almost $1.4 million. The cost of goods sold went up by a little over $900,000. The gross margin was about almost $466,500. So the selling administration expenses went up. Of course, the taxes went up, and then our net income would be favorable over the original problem by almost about $235,800. So that's a very aggressive approach to the problem. So we took that and looked at what would happen if we only increased the price of the C15, but we did not, and we also lowered the price of the C60, but what if we didn't get the benefit of the extra doubling our production? So we looked at that extreme to see what would our outcome be. So you can see the combined total sales would drop by about $120,000, but there would be no impact to the production budget. The direct materials budget would not be impacted. The direct labor budget, the manufacturing overhead budget would not. The only impact was the selling and administration budget, because with the reduced sales, we would actually have less commissions to give. So the budget income statement, you see here, the sales would go down by $240,000. The selling and administration would go down by $12,000. And so our net income would actually decrease by $136,800 in that approach. So that would be our extreme low. So then we said, well, okay, what would be a happy medium if we looked at this? Would be low risk, but we'd still get some bang for our buck. So the C15, if we go ahead and raise that price, because we're only increasing the price by 6.67%. We've been building this product a long time, so it seemed favorable. We hold the sales price for the 220 because it's still a relatively new product on the market. And so what would that impact be? So we would have a sales increase of about $120,000. But because the production did not change, it's only price of sales units, so the production budget wouldn't be impacted. The direct materials budget wouldn't be impacted. No impact to the direct labor budget. No manufacturing overhead benefits or decreases. The selling expense would actually go up by $6,000 because we had an increase in sales. And so when you look at the bottom line, the budgeted income statement, the sales did go up by $120,000. Our gross margin benefit, because the cost of goods sold didn't change. Cost of goods sold did not change. We did have an increase of the sales expense, but our overall, we would have a favorable variance to our net income of $68,400. So it is our recommendation that this is a much favorable approach to the problem, less aggressive, but also a lot less risk. I'm going to pass it on over now to Josh and let him go through problem number 3. Thanks.
Thanks, Bill. Question number 3 states, the management of Wonky Widgets Company has had a continuous improvement program for a few years. Consequently, management anticipates C15 and C60 can be manufactured with the following specifications. Management expects that the variable manufacturing overhead will decrease by 10%, while the fixed manufacturing overhead will decrease by 5%, except for depreciation, which will not change. Management does not expect the price of raw materials to change, but the hourly wage rate is expected to increase to $30. None of the other items in the problem introduction will change. What is the budgeted after-tax operating income if management can achieve these changes? So we have chosen to highlight which domains are going to change based on the new information. So we have new information regarding the raw materials needed per unit, which we're going to input here. And so this changes the raw materials needed for us to meet production. So you'll see the new totals indicated here of the raw materials needed to meet production. The desired units of ending inventory will remain the same. So we have a new total units of raw material needed as follows. Each are less than what we had previously calculated with the new figures. The beginning raw material inventory will remain the same. And then the units of raw materials needed to be purchased are calculated as such. The cost of raw materials per kilogram will remain the same. And then, of course, the cost of raw materials to be purchased is going to be different based on the adjusted figures that we received. So the new total for cost of raw materials to be purchased is $437,680. Our direct labor budget is also going to be adjusted based on the new direct labor hours per unit that are needed. We adjust the total direct labor hours needed. And then we have a new direct labor cost per hour of $30, which was identified in problem number 3, for a total direct labor cost of $1,078,500, significantly different than our previous total direct labor cost. We also have an adjustment when it comes to the budgeted direct labor hours from the section above. And then, as identified in the problem, the variable manufacturing overhead rate is decreased, as well as the fixed manufacturing overhead rate is decreased. So we have a new total manufacturing overhead cost. Depreciation stays the same as indicated in the problem. And then our cash disbursements for manufacturing overhead now comes to $377,754.50. We're going to move our numbers down here. Our selling and administrative expense budget remains the same. And then when we get to our budgeted income statement, our sales remain the same. A new cost of goods sold brings us to a new gross margin of $2,263,820. Selling and administrative expenses remain the same. A new net operating income of $1,435,320. Less our new taxes gives us a new net income of $861,192. Thank you for your time.